Welcome to episode 11 of Money Matters. We're going to talk about a number of different aspects to see if this rally has legs or not. One of the concerns that we're obviously hearing about lately is bubbles and black swans, and we'll see if that is a genuine concern for the next 2 or 3 months. I want to bring up an issue that is increasingly problematic around the government shutdown, which is the data is not being published. The data is becoming more and more stale, so much harder to forecast. And that is likely to leave investors slightly antsy in terms of what those unemployment, CPI, manufacturing numbers could look like. We're going to talk about a strategy for the time, and that is really kind of thinking about the earnings that are coming up and how resilient the markets can be with the volatility that's due from these earnings. And then a quick comment on the banking sector, because we had a little bit of a wobble at the end of last week. So let's talk about this issue of the government shutdown. We're now in the third week of that process. We mentioned last week, we don't think that ultimately at the margin, this makes a big difference to growth for the economy, or for that matter, an impact on the stock market. However, having said that, it's now been 3 or 4 weeks since we've had unemployment numbers, which tend to come out weekly. And what we also haven't had CPI, manufacturing, confidence type of data that is normally due almost on a weekly basis. Obviously, the inflation numbers are monthly. Forecasters tend to take the most recent numbers and build on that. But given that we haven't seen the unemployment numbers, particularly for some time now, it feels like that potentially investors could start to have a dispersion in terms of their assumptions of what comes next. And that might create some fear in the market for when the government does come back and start issuing these announcements. So that's just something to keep in mind, that stale numbers are never good. The 10-year in the US is currently below 4%. That's below the Fed rate. And it's also incredibly positive for the mortgage market, because the mortgage market in the US tends to price off the 10-year bond. That implies that we have got a scenario where we could see a potential uplift in the mortgage market, in the housing market in the US. And that is another clear sign that we are not in a recessionary environment at this juncture. In fact, so much so that these black swan event talks and bubbles, we think, are still not a realistic outcome for the next few months. We're going to very quickly start to see the benefits of the big, beautiful bill in terms of the tax reduction implementation. That puts more money in consumers' pocket, and that, generally speaking, and that should be a positive in terms of spend. We think that ultimately President Trump sees the stock market as a report card on his accomplishments and achievements. And longer term, this is something that he's very serious about, and I think is quite supportive, and if you like, is a bit of a safety net for the market in some respects, although I wouldn't rely on it too heavily. The tariffs are clearly negative, and the tariffs being discussed, whether it's China or elsewhere, have come and gone in waves and have frightened the market, generally speaking. And they are certainly a tax on the consumer, on the US consumer per se, potentially neutralized by the benefits of the big, beautiful bill tax implications. I'm looking at it a slightly different way, because one of the key elements is that both with interest rates falling, clearly that means short-term debt funding reduces. But also at the same time, it's interesting that receipts from the tariff program will probably also allow the government to have sufficient funds, at the margin at least, not to have to put pressure on short-term rates at this juncture as well. So all in all, that reduction in rates scenario and a reduction in quantitative tightening is also very supportive of risk assets in the stock market. So I see that continuing again for the next 2 to 3 months. Market has assumptions of 2 further interest rate declines in the US. I would say even just 1 will continue this momentum. And then finally, the consumer, certainly from comments made by the US retail sector to date, has been proving to be very resilient. Furthermore, when we look at these tariff discussions with China, You can see that Trump has come back and become much more conciliatory in his position. And we think that's probably likely to be the case going forward. One thing to keep in mind, however, is that we are high valuation levels. We are now into the Q3 earnings season. And the implication for me is that in that kind of environment, stretched valuation environment, companies really do need to bring to the fore very strong earnings announcements. And that will either support or even result in a strong performance. But any shortfall against expectations, I think will be punished quite severely, at least in the short term. And I think with that in mind, one of the potential ways to play that, particularly as a professional investor, and of course you have to go and do your own homework on this in a very granular way, but when you have a portfolio of stocks that you believe in the long run and you're worried about the short-term volatility, then selling covered calls on those positions is potentially a right strategy for some hedging exercise in these kind of times. And that involves collecting premium whilst you're holding that covered call. If the stock happens to fall, you're going to make money on that. You can take the option profit to cover the loss in the stock price that you own. And that should hopefully neutralize downside risk. And if the stock goes against you, then you close the position, you've collected some premium, and you've lost on the option, but you've made up on the stock. So again, it should, to some extent, reduce your potential upside if you had no hedging in place. But in this kind of environment, when I do believe that we need to be a little bit concerned about the stretched valuation and what earnings could imply, some covered call selling on your portfolio does, I think, make some sense at this juncture. We did see a big wobble in the regional banks in the US last week, and that was partly to do with idiosyncratic fraud announcements by a couple of the banks. I don't believe that this is something that is long-term or a problem with the banking sector. In fact, at the same time, the big money center banks, Bank of America's, Wells Fargo's, JP Morgan's, have all suggested that their net interest margins, their NIMs, are actually expanding, not surprisingly, in this kind of environment, as the yield curve starts to offer the opportunity to obviously borrow cheap money on the short end and lend expensive money on the long end. And at the same time, they are talking about default rates being at relatively low levels, which is encouraging. And so again, back to this resilient consumer. So I still believe that dips at this juncture are to be bought and not sold into. I can't see any kind of evidence at this juncture of a breakdown in the economic momentum in the US. And so I do still believe that the US remains the largest overweight in a portfolio, certainly until year end, because it has the biggest level of momentum given the interest rate reductions, the QT removal, and the general increase in liquidity into people's pockets from the big, beautiful bill. So that's kind of my thought at this juncture. We do have some interesting results coming out this week. We've got Netflix later on today. We've got Tesla, we've got General Electric, and we have got Coca-Cola, which again could give some indications of the consumer habits at this juncture. So we'll keep you updated. If some big numbers and big announcements are made this week, we'll come back for sure. But otherwise, have a great week, and we'll catch up next week with more news from markets.